So, John, we've been talking about it, for weeks now, the Russian-Ukraine war impact on the markets. You're actually watching the energy market in particular and how increasing Russian sanctions are creating some action there. Can you explain it for us?
Sure. Well, we've talked about crude oil, of course, and natural gas stocks, which have skyrocketed and then sort of plateaued, Frank. And they've sort of passed the baton, if you will, to the uranium stocks. And of course, this is because they are an alternative to the fossil fuels. And so we've seen Camco, which is CCJ, see a lot of activity. Right now, we're seeing an awful lot in UEC, which is another uranium play. It's about a $5.40 stock, Frank. And right now, they're buying the April 5 calls. So these calls expire next Friday, not today, but next Friday, slightly in the money call. And they bought the equivalent of about 800,000 shares. That's 8,000 option contracts. And that's yet another bet on uranium continuing to move higher as Germany, who is going to quit with its nukes by the end of this year, instead, of course, is going to be competing for some of those uranium stocks so that they can continue to light up that country.
So some really bullish call buying here. How long do you see this kind of action being sustained for? Because obviously we don't have a lot of visibility into, how deep these sanctions could go or how long this conflict could last.
True. And one of the things that we've said all along, too, Frank, has been that when we're looking at these sanctions and the war itself, of course, even if the war were to mercifully stop, I don't think those sanctions come right off. I think we are likely to see these prices remain high and push even higher because the sanctions would likely stay in place. And that would mean competition for everything from mined materials to, like uranium, to crude oil and natural gas are going to continue to move higher. That's my bet. And obviously, everybody that is putting down those bets has a similar outlook.
Right. Let's talk about the actions, the options action, the materials space. Now, correct me if I'm wrong. I don't think materials are generally a place where you see a lot of options action. One area is nickel. Obviously, a lot of nickel comes out the Russian-Ukraine region. Can you tell us about some of the call buying you're seeing there?
Sure. Well, nickel is something that Russia's the #1 producer in the whole world of nickel. And most of your viewers know this, Frank, but nickel is something that's necessary for the lithium-ion batteries. You can't make them for Tesla or anybody else without nickel. Lithium's the big part, but nickel's just as important. And if Russia is indeed cut off from delivering that, they'll only be selling it apparently to China and India. So the second biggest nickel producer in the world is Vale, V-A-L-E. And that one we're showing strong activity in the calls out to May at the 23 strike. And that was when the stock was a little over 19. The stock's been moving up, but still they're predicting that the stock goes considerably higher, mainly because of those nickel reserves that people are so anxious to get a hold of now that Russia's going to be cut off.
You're also looking at steel, right? You're seeing a lot of bullish call buying for Cleveland-Cliffs?
Yep, CLF. Just yesterday, we saw 10,000 May 35 calls, bought. And that was with the Cleveland-Cliffs at 31. So they are sort of a full service. They go out and mine it and then turn it into rolled steel. And Cleveland-Cliffs to see like a $4 rally in the next 3 or 4 weeks into that May expiration, that's pretty bullish, Frank. Bullish for Cleveland-Cliffs and bullish for the industry supplying more steel because demand is that high.
All right, John, we almost got to get out of here. Quick take on the market day ahead after what we saw yesterday to close out the day.
I think a lot of it for the remainder of the week, this next 6.5 hours of trading, Frank, will probably be that 10-year note. And we saw a very fast jump to almost 270 for the 10-year. If it stabilizes here, then that's going to be something that the market will take note of. It doesn't want it. The market would prefer not to see higher rates hit us this quickly. Maybe a little plateauing in rates would cause the markets to stabilize even more.